what was happening in the Jane Street saga was sort of like the tail started wagging the dog. Right? If I remember correctly, they had at one point of time more than 10,000 crores in margin.
Okay.
They would come in, they would buy, say for example, a call option in heavy volumes. That call option buying in heavy volumes would force market participants who would become short that call to quickly go elsewhere and start buying futures or start buying cash market or start buying banking stocks. I mean, that buying would print their options. So normally a derivative derives its value from something. Options, we call options derivatives. So options derive their values from the underlying. Here it became the other way around. Aggressive option position taking caused an outsized effect on the underlying, forced all the other market participants to take the other side of that bet and then move the market in favor of their option position.
So, Shreyans, in one of the answers you mentioned that market makers generally never make kind of big losses or losses. It's either flat or they are in the profits. So, what kind of risk management or the execution discipline you guys used to follow? And was it sometimes that in your 8 years of your career, did you see a big loss? And if yes, then how big it was? But all 250 odd trading days, every day you need to take an expectation about a quieter day or a kind of an actionable day. So what was your strategy behind finding?
So one of the largest things that influenced our views was the realized historical volatility. If we see that the product that I'm trading has very low 3-day realized volatility and there are 3 days to expiry, and there are no news events expected for that particular stock, so we can reasonably be sure that the market might remain quiet. Now obviously all of these expectations, they go out of the window whenever there is a large move. Then market makers have to go into firefighting mode.
So let's say you talked about being short Vega. So if you want to go short Vega, generally what are the things which you will do? I mean, you will maybe short call, short put, maybe shortest triangle or shortest straddle, or are there any other ways? Welcome to Off the Charts, where we decode the complex corners of the market with people who have actually lived them. In the first episode, we had unpacked the institutional trading world. What happens inside a mutual fund or a hedge fund desk, and we compared it with the retail trading. In the second episode, we moved on to see how AI is reshaping the trading itself. But today's episode takes us even deeper into the engine room of the markets, the world of market makers and high frequency trading firms, or what we call as HFTs. These are the silent players who coat both sides of the markets, arbitrage inefficiencies across instruments, and keep the system liquid, most often in microseconds or even nanoseconds. My guest today, Shreyans Jain, has spent 8 years at one of India's top proprietary trading and market making firms, one that competes with the likes of Tower Research or AlphaGrep. Shreyans has designed and executed delta neutral, volatility based and cross asset strategies. And today he is here to help us understand what really happens inside those trading flows. Hi Shreyans, it's a pleasure to have you with us today.
Hi Vaibhav, likewise, pleasure is all mine.
So Shreyans, before we get into the technicalities, I want to understand what is actually market making. What role do the market makers actually play in the entire investing ecosystem?
So market making is also colloquially called jobbing sometimes. It is essentially a service that certain strategies provide to the exchange. Primarily, what it does is it provides liquidity. So in times when there is a large directional move in the market, what market makers will do is that they will ensure that the spreads remain same. They don't increase with, obviously they increase a little with sudden spikes, but they come back to a normal size. And secondly, that when there are large directional moves, so market makers sort of ensure that all linked products for which the prices are linked, for example, HDFC Bank futures are getting bid up. So market makers will ensure that HDFC Bank option prices are also moving in sync with the futures.
Okay, so simply speaking, what a retail trader is looking at the bid-ask spreads, which is, let's say in Nifty, it is very tight, maybe 5 paisa or even 10 paisa. So the liquidity which we see on the screen mostly you would say that it is because of the market makers that the spreads are so tight. And if the market makers are not there present in the ecosystem, what sort of spreads would you probably, as a retail investors, we would see?
So most of the times, the tightest orders are almost always of market makers, almost
Okay.
always. And what would happen if market makers are absent is that whenever there is a large move in the underlying, all option prices will move out of whack, and they'll take a lot of time to come back into sync.
Right.
So, for example, HDFC Bank gets bid up 10 rupees. At the money call should get bid up by 5 rupees. But what will happen is that it might get bid up by 7 rupees, and then there is a 3 rupee spread temporarily. So
Got it.
problems like these are all solved by market makers because we are liquidity providers.
Put both the sides of orders, like bids and ask, both of them, right?
Exactly. So that is by definition, market makers have to be ready to take both sides of the market. Any person or any strategy that is only either quoting on the ask side or the bid side, it is a direction strategy. Essentially, there is a directional bias, and market makers are by definition, they want to earn the spread. They don't want to earn on directional moves.
So your revenue is all tied up to what are the spreads you are probably making into
Yes.
from both the sides bidding.
From both the sides. That is our bread and butter. And the more the volatility in the market, the more the volume in the market, the greater the chances for a market maker to remain delta neutral and continue earning that spread.
And what kind of days would you probably earn the most? I mean, which kind of days are good for you from your revenue point of view?
For a non-directional options market making strategy, the largest revenue days are days which are very volatile in both the directions. So if the index is giving a good up move and down move, those are the days where options market makers can make a lot of money.
Oh, understood. Interesting. See, you have spent almost 8 years into a market making company, right?
Yes.
So how did you get into that there? And then what was your typical day look like? What was the role which you were playing over there? So if you can just shed your light over reflect back into those 8 years of journey, what can you add over there for us?
So a typical day starts, the trader has to be sharp and ready at the desk at least half an hour before market starts. So when I used to trade the Nikkei 225, the Japanese index, it used to start at 5:30 a.m. Indian time. So my office started at 5 o'clock. You get like a half an hour to get your coffee, get your, your news. You have to follow up on news, international events, and then data points are very essential. So if in the overnight session, when the options market was closed, there was, say, a US crude oil inventory report, or for example, Italian GDP numbers or Japanese PMI numbers. So you have to be aware of all of these data points that were published in the overnight session. The negative part of reading and following all these news is that it creates a bias, which is what market makers cannot have ever. Otherwise, because if you have a bias, you cannot remain delta neutral in the market.
Of course, that is what I was about to ask, that you need to anyways provide liquidity. So how was the news actually impacting your business or impacting your strategies of providing liquidity?
Yeah, we create a view on the IVs. So for example, if today at market end, I'm on the screen, I'm trading, and in the overnight session, I know that Japanese GDP numbers or US GDP numbers are going to get released. So market IVs are expected to get bid up. If they are not bid up, market makers can have a view on the IV. We can go Vega long in the overnight session if the walls are not bid up, but we avoid taking any delta direction.
Understood. So basically, you will have to have some kind of kind of an expectations that where the market might go. But how will that help? Let's say you understood that today maybe GDP numbers are being released and the market might go up. So how will your market making or the liquidity or the kind of providing both bid and ask spreads change in this view? I mean, it is your strategies are going to become a delta positive, or you have to bring it back to your delta neutral.
I can only have a view on the IV. I cannot have a view on the underlying. If there are GDP numbers coming up, I will never have a bias that market is going to go up or going to go down. I might have a view that IVs are expected to go up before the print and they are expected to go down after the print.
Understood. So you mentioned that you traded Nikkei 225, which is Japanese index. So in your 8 years, did you only focus on Nikkei, or there were other Indian indices or other global indices as well that you
I
were trading?
started my trading journey with currencies. I used to trade USD INR on NSE, BSE both. Then I shifted to Nikkei, Nikkei 225 Japanese market. I did that for a couple of years. I used to trade the morning session. Then I shifted to commodities. In commodities, we traded on CME. CME is a 23-hour market. So it was always done in shifts, like 2 to 3 traders used to cover the CME market. In CME, we traded gold, silver, crude oil. And finally, I ended up in the Indian market. And then I traded Bank Nifty for 4 years exclusively. And then we added some other spots, HDFC Bank, ICICI Bank, L&T, Nifty, all these products with time. Yeah.
Okay, so not only indices, but even stock basis you were primarily dealing with. Understood. Again, a lot of questions on that, Shreyans, but we have seen typically these kind of players using multiple monitors and screens and movies and all. How many screens did you have, and what were the purposes of each screen generally?
So in my office, I had 8 screens, 24 inches each. And all of the screens had the option chains of different products that I was trading. If I was trading, say, 6 products, so each product would have a different sound that indicated an executed trade. So, yeah. So with time, we got trained to look at a particular screen depending on the sound we heard. That is how we were able to keep track of so many products. And one essential thing is that every HFT trader, every trader that I know, almost always has a laptop on the side on which they are scrolling Twitter continuously. And Twitter specifically because we need news the fastest. Like we can't wait for any news or any earthquake, for example, to reach cable news and then we react to it. Because it's are almost always the first to react.
So, would you be comfortable sharing some of the Twitter handles which are publishing the news at the speed of it? So, if
I'll share the list. We'll see if you can put it up on the video itself. There are 3-4 pretty good handles which continuously share actionable information.
Awesome. That would be great. And you mentioned something about HFT in your previous answer. HFT, as I understand, high frequency trading, but we have also heard terms like LFT and MFT. What is the difference between all these things? Is it just a strategy or just a nomenclature about time taken to put orders or something like that?
So HFT is almost always sub-second trading in which your strategies are defined and you execute them on a tick by tick data. You always parse tick by tick data and you are always focused on even the smallest inconsistencies in the order book in the market in its allied products. MFT is more between, say, a few minutes to a day. LFT, there is no such thing as LFT essentially. It is what most retailers would do. It's buy and hold, buy and sell. Buy and hold strategies.
Okay, so something which the investors are doing is actually called LFTs.
So this is just the wording. In terms of strategy, so HFT, since it's the fastest strategy, almost all arbitrage strategies are HFT strategies. Almost all. Almost all directional strategies are MFT strategies.
Okay. That's a good differentiation. So let's get deeper into what arbitrage strategies are basically. And you spoke about that being delta neutral. You spoke about IVs. I would want you to kind of pick one by one each, and then just tell that how were you actually kind of creating your strategies around all these processes. And
so I was an options market maker. So I am more comfortable sharing an example of options arbitrage, right?
Sure.
So in options pricing, as per the Black-Scholes equation, there are only 5 variables in it, of which 4 variables are known by every participant in the market.
Right.
Which are price of the underlying, days to expiry, strike price, interest rate.
Correct.
These
Correct.
4 variables are known by each and every participant.
True.
So the entire game is of valuing the IV correctly.
Which is the fifth part of the equation.
Fifth part. Yeah.
Yeah.
So that is what options market makers do, is that they try to guess where the IV is heading. So for example, if Bank Nifty ATM IV is at say 18%,
Okay.
and we are expecting a quiet session till expiry.
Right.
2 days to expiry, we are expecting 2 quiet days. So options market makers, even though we are not allowed to take a view on the underlying or a delta position, we can take a short Vega bias, indicating that we want to earn the theta from shorting these options. And our estimate is that even though options are pricing in an 18% volatility, realized volatility, but the market might move at say a 12% realized volatility.
Because it's going to be a quieter day, as per your expectation. Okay.
As per our expectation.
Yeah.
So that is why options market makers will almost always only take a view on the IV, which is the single unknown variable in the entire Black-Scholes equation. Black-Scholes equation is the formula on which all option prices across the world are, of course, European auctions are all based across the world.
So how did you form those expectations? I mean, what all things did you see that, okay, it is going to be a quieter day and it is going to be a, obviously, see, what my understanding is that the budget days or the election results days, these have to be the, kind of a very volatile days. We all know that. But all 250 odd trading days, every day you need to take an expectation about a quieter day or a kind of an actionable day. So what was your strategy behind finding?
So one of the largest things that influenced our views was the realized historical volatility.
Right.
Obviously, there is a disclaimer and always that past performance is no guarantee of futures. So it is only a hint. If we see that the product that I'm trading has a very low, in the look back period, very low 3-day realized volatility, and there are 3 days to expiry, and there are no news events expected for that particular stock, and there are no large news events expected for the larger economy, like there are no GDP prints or there are no GST council meetings, for example. So we can reasonably be sure that the market might remain quiet. Now, obviously, all of these expectations, they go out of the window whenever there is a large move. So if you're expecting it might be a quiet day and there is a gap up opening, gap down opening, or it's a very volatile day, then market makers have to go into firefighting mode. We have to, if we are short Vega, we have to somehow, we scramble to buy as much Vega as possible from the same product, from allied products, we make calendar spreads. These are all ways, or we do cross-hedging. These are all ways to reduce your exposure and reduce expected losses, even if there are large moves on a short Vega position.
So let's say you talked about being short Vega. So if you want to go short Vega, generally what are the things which you will do? I mean, you will maybe short call, short put, maybe shortest triangle or shortest straddle based on the underlying Nifty, Bank Nifty or whatever. Or are there any other ways probably you could go short Vega or maybe short Theta?
Because like we discussed earlier, that market makers will have bi-directional quotes on all options across the option chain.
Correct.
So it cannot be reduced to calling it a straddle or a strangle, since we will have multiple open positions across calls, across puts, across expiries, across the option chain. Okay. So what we generally do is that initially for smaller moves, we take positions that the market will give us. So for example, the day has started. I'm trading, for example, HDFC Bank. It's been a quiet opening, and I have all my quotes, all my orders in place. Now, as the market is moving, the IV might swing up, swing down, swing up continuously. It can do or stay stable. Wherever the IV goes within a limit, we will move against it. So if IV is getting bid up 1 point, I will continuously sell, take the IV up till a point where I can finally cross the spread and start buying. And then I will keep buying and I'll reduce the IV. Same for if it's a volatile day or whatever product it is. This is generally riding the wall of the market. What happens is that if the IV moves beyond the range, So market makers also have margin limits, position limits, and exposure limits that you are allowed to take. So if IVs shoot up beyond a range, then we have to start cross hedging, like I explained previously. And cross hedging we do either in allied products or we do it in across expiries. So with expiries, it is easy to do in terms of index because in the index, weekly, monthly, both are very liquid. Usually, second month is also decently liquid. But in case of stocks, there are no weeklies. The second month is almost always very liquid, spreads are wide. So if you want to hedge a position that you have been given by the market in the near expiry, you have to pay a spread to be able to do it in a far expiry. So most of the time what we will do is in case of stocks, we will cross hedge it in a different product. So if because of market IV moves, I am becoming short Vega in the near expiry in say HDFC Bank, I will automatically start bidding IVs in ICICI Bank, Axis Bank, SBI, Bank Nifty, and all these other allied products. As soon as HDFC Bank's IV stabilize or start to fall, I will automatically buy and I will automatically try to sell the Vega I bought in these different products. This is just a way to reduce your exposure while continuously trading within your risk limits.
So this, so you are saying you got into ICICI Bank, Axis Bank and all because these are supposedly correlated with HDFC Bank. So do you in real time try to find what is the correlation between all these stocks and then accordingly put a number, how many lots to maybe buy or sell for maybe ICICI Bank and Axis Bank and all, and how quickly all these things have to be done to be
these have to be done in an automated way because these are split second decisions. These cannot be taken by
can't do manually.
It has to be done by a computer. We use a Bloomberg terminal. I'll share with you a chart which shows, so you'll see it's a pretty high correlation in terms of directional moves, and there is a pretty high correlation in terms of IV as well. So if IVs in SBI are falling continuously and it's a quiet day, over a period of time, IVs in say IndusInd Bank is also expected to fall.
Oh, understood. So basically all these things you are doing and whatever I understand for the HFT, these are very large ticket size trades. Like maybe it might go into what, $1 million as well, a single trade?
Oh, easily. Single trade, so there are, I think, limits by the exchange on the maximum order size. When I was trading, I think it was 70 lots in Bank Nifty was the largest order. I'm not sure, but there are limits to a single trade. However, if I'm not talking about a single trade, if you look at the overall trading cost per day, it could run into hundreds of thousands of dollars per day.
But was it possible that your orders were also kind of moving the market prices of, if not the index, but maybe for the stocks?
So if I talk about say Bank Nifty, I don't think there is no single trader that can move the Bank Nifty index. It's a very liquid product. It is, I think, one of the most liquid products across the world, not just in India. But if I look at a product, say IndusInd Bank, so it's a fairly liquid product wherein if a market maker has a bias, they can be cases wherein, the market maker has himself shifted the IV in that product because those are fairly liquid, spreads are wide, and it's a cost to hedge every position in IndusInd Bank itself.
Got it. So, okay, Shreyans, we discussed about Vega strategies. We have discussed about delta neutral. What about Theta Decay? We all know that, kind of lot of retail players try to play the, 0 days to expiry, ZTD expiries on the expiry date just to get the Theta. Right. I would want to understand from you that recently, if you have been following, I don't know how much you follow the markets now, but the Sensex and the Nifty expiries have been swapped. Nifty is on Tuesdays and Sensex is on Thursdays. Do you think was there some kind of a Theta Decay change which has happened when someone is kind of trying to play maybe Nifty because of the weekend, so Saturday, Sundays coming in? Do you have any view on that, how that might have affected market makers or trading in general?
So Theta is essentially time value of money. But for market makers, no two time periods have the same value. For example, Indian market opens at 9:15. So the theta value that any market maker would assign to the opening trade would be much higher than the theta value they would assign to, say, a quiet time in the market around 1 o'clock in the afternoon. Then again, a higher theta value for the closing session. So it's no two time periods are the same for a market maker. And these things can be modeled nowadays. There are many fantastic models developed which can automatically create theta profiles, and those can be used to efficiently bias your volatility curve.
I'll come to volatility curve and smile a little later. But again, so what we know is that every second towards the expiry, your theta theoretically continues to, in fact, your option premium continues to go down because you're getting closer to your expiry. Now, you said that, and what we also know from the curve of theta, that the option premium is actually, I mean, the play of theta is maximum towards the very close to the expiry time.
Yes.
Right. So we have seen a lot of theta decay from, let's say, 2 p.m. to 3:30 p.m. to on the expiry day. You said that the theta decay is higher even at the start of the market time, 9:15 to maybe 10:30, and that slows down. A little bit more light on that. You say market makers, for them it is not equal, but what about the retail players? How can retail players get the idea from market makers and then make probably more money in the markets?
So this theta decay that I was referring to was not a 0 day to expiry. I was talking in general. So if an option is like 7 days to expiry, so the morning session might have a higher theta value than the afternoon session. In case of 0 days to expiry, I'll see if we can put up a chart here. The value of theta will continuously increase till the time of expiry. So in 2 days to expiry, obviously the higher weightage will be from say 1 o'clock to 3:30 during expiry.
Okay. So retailers are right, at least in this on the expiry day, maybe whatever they are trying to play.
So retailers are almost always right. So one rule we had in market making is never fight the trend. Never fight the trend. Yeah.
Okay.
Because market makers have a limited margin. So we might think we are theoretically correct in taking an IV position, but no amount of margin is enough to go against the trend in the Indian market. It is so liquid that if walls are getting bid up, IV is moving up, there is no one point where a market maker can keep on selling and say, okay, now we've reached the top. Now we can start, selling. Now we can start buying. It is, you can continue to sell as long as it is rising, and you can continue to buy as long as it is falling.
Okay, while we are at the theta discussion, we know that even the theta decays over the weekends as well, right? So when the market is not functioning. So do you think it makes sense for now that Nifty options are expiring on Tuesday, someone to take a short maybe playing the theta decay on a Friday? And how do you think that if there is a holiday on, let's say, Monday or any other such days, how does that impact the traders?
So if there is an expiry on Monday, for example, so taking an overnight position at Friday end of day is much riskier than if expiry is on Tuesday and you are taking a position at Monday end of day. Because even though, for example, an overnight theta might be given the same value for the market makers between Friday and Monday or between Monday and Tuesday, because overall time between Friday and Monday is larger, it's 2 days. And in the uncertain political environment we are in, there is a very high chance that some news event might come up that might bias an opening on Monday.
Okay. And we know that these days, anyways, any tweet coming in from across the borders actually change the markets a lot. And most of these tweets are actually over the weekends. So generally it is advisable for people to not take naked option position on a Friday because anything can happen. So I think what you are trying to say is that in these kind of cases, the directional impact is more than probably the theta decay which these guys might get.
Exactly. Yes. For most market participants, theta, you can say, decays linearly. 1 second time value is the same today, tomorrow, whenever. But market makers can sort of model and create theta profiles wherein we can assign a higher theta decay to 1 second value, say in the market opening time from 9:15 to 9:15:01, than say in the afternoon from say 1 101. Yeah. So one another way, because all these Greeks are linked, right? So modeling a theta profile is essentially the same as automatically moving your IV according to how much move is priced in that time period. I don't know if you get this. So a higher theta profile means there is a higher a higher theta decay means that there is a higher probability of an IV move in that time period.
So, Shreyans, we actually, a lot of market makers now that we know is that there are a lot of certainties which are anyways factored into the option prices, underlying this and that. But recently, in the last maybe couple of years, we have seen that there are unexpected holidays announced by the government. And then they ask that, over the weekend, the trading will happen. I think it has happened twice or thrice, if I remember, in the last 2-3 years. How do market makers then, adjust their positions, and what happens over there?
So market makers want certainty because
Exactly.
we have such large positions across so many products at a given point of time that all that market makers want is certainty from the regulatory environment. So you will also see that mostly across the world, most exchanges will avoid announcing holidays at the last minute. What they will try to do is at the start of the year, NSE will come out with a circular that these are the holidays.
Correct.
Only these are the holidays.
Yes.
However, what happens is, I'll give you an example, Maharashtra election dates. It is something that even the exchanges don't know. They can't account for a holiday. So, election dates, Bombay, the day that Bombay is going to polls, there might be a holiday. These things are still accepted by market makers. But if there are holidays announced for reasons that were avoidable, for example, it throws all of our calculations out the window. And market makers are working to earn just the spread. So it's like earning just a few cents on a trade. However, doing that trade thousands of times a day. That is what we do. So if there is a holiday announced, for example, Thursday is an expiry day, and on Monday the exchanges have come out with a circular that Tuesday is a holiday.
Right.
Just for example. So all of a sudden, if my option pricing had like 4 days of trading priced in till expiry, now because of the circular, all of a sudden it's just 3 days of trading.
3 days, correct.
So option prices are expected to swing a little wildly whenever this circular comes out. They do come back in line, but if any option market maker is stuck in a large Vega position or a large calendar spread, it is very difficult to come out of it profitably.
I think you had already left by the time these some of these days came recently. But do you have any idea whether the companies actually definitely lose money on these days, or there might be some chance that they are in that position where they can make money also?
Market making firms will almost never lose money. They will either end up flat or end up with a small profit. Is what this strategy entails. That is why you have to be the fastest. It's an arbitrage, essentially. Arbitrage is riskless money. Right. So if you have something that is riskless, you will continue doing it at as fast as you can, being faster than the other players. So market making firms, obviously we all make mistakes. Even I have made many mistakes, but most of the time they will come out on top even in situations like these.
But which would be the most profitable stock where you might have made money in the entire bank spectrum in India? Just curious to know that. ICICI Bank, HDFC Bank, SBI, no?
I think it is all decided by liquidity. So HDFC Bank options used to be one of the most illiquid. I think up until 2019, they were very illiquid.
Right.
So we didn't earn anything. We just had a presence. And then I think since 2019, it started picking up in volume and then eventually became one of the most liquid options. So it's all decided by liquidity.
So how did that happen? That till 2019 there was no liquidity and all of a sudden liquidity started coming in? Because I know that TCS, for example, I was trading, I was creating some retailish strategy on options. It did not have liquidity. But I think Infosys has more liquidity than TCS. if I am thinking correctly.
It's been years since I've
For you, obviously.
but
But
yeah, maybe one of the reasons why HDFC
yeah,
was picking up in liquidity could be that HDFC Bank has an outsized impact weightage in the Bank Nifty index.
right,
Bank Nifty index is extremely liquid.
right.
So a lot of traders, a lot of arbitragers will take positions in HDFC Bank as a way to cross hedge their Bank Nifty positions. So hence HDFC Bank liquidity is increasing.
I was just trying to understand if exchanges had a role to give to the market makers, that you need to increase the liquidity of HDFC Bank stock, just like we discussed about Sensex.
The exchanges also, regulators also, there was a STT rule
Yeah.
in India which was very unique. It was nowhere else in any part of another world, wherein the person whose options expired in the money had to pay a tax depending not on how much his option ended up in the money, not on his profit, but the notional value of
Notional value, correct.
yeah.
Yeah.
So these rules were very swiftly changed by the exchange, and STT rule bringing them in line with the profits. This greatly helped increase volumes in stocks,
Understood. Okay.
in stock options. Sorry.
In stock options. So, Shans, while you were in the system doing all these things, so I guess those days, every day was some index which was expiring, right? Every day, maybe, right? There were weekly options, and you might be aware that now there are weekly options available only on Nifty and Sensex, and then all of them have moved to monthly. Do you have a view on how market makers' profitability might have been impacted by this move? And recently, what we are hearing is that even for the weekly options on Nifty and Sensex, the regulator might be deciding to move them also to monthly or maybe fortnightly. Any view on that, how this is good for the markets, good or bad, or for the market makers in general?
So weekly options are a speculating tool. Essentially, it is for hedging. Mostly, most people, I'm not saying all, most people will have a slightly longer time frame wherein they will depend on monthly options.
Correct.
So weekly options are for speculation, essentially. It is exchange initially had weekly on both Nifty, Bank Nifty. It drew speculators from all over the world because it was very liquid. For anybody to, like, slippages were low, cost is low. NSE, BSE, both of them are world-class exchanges in terms of infrastructure. They're like fastest in the world. We traded multiple exchanges, and we almost always found fault with the exchanges infrastructure or the exchanges system of working. But in case of NSE, it is fantastic. We have never come across any issue with the exchange. It is very pro trading. It is the rules are set in a way that any new trader ready to HFT can very easily set up shop. Rules are very stable. Costs are very stable. So I think one of the key reasons for India's equity options having such large volume was both that we had world-class exchanges, and those world-class exchanges had weekly expiries in their leading indexes.
This concept is not, this concept is a borrowed concept anyways, right? I mean, I remember till 2014 or 15, weeklies did not exist. I don't remember exactly which year they introduced, and then they gradually kept on adding different indices to be expiring. So, and now obviously phasing it out because now the retail investors has got a, kind of a hang of it, and so they want to reduce. But you are saying that Indian exchanges are by far the best because you have traded Japanese exchange. I think you also mentioned you have traded Brazilian exchanges as well.
Yeah, we did B3 as well. So they have, Indian exchanges are pretty pro traders, pro business, very stable rules, stable pricing structure, very fast market access. I think, if I'm not mistaken, BSE, I think, is the world's fastest exchange, low round trip times. They have a very good market infrastructure, co-location services, gateway management. It is top notch.
So let's come to co-location. What is co-location, and how did people, kind of setting up their servers in the vicinity of exchanges were getting benefited. So can you just elaborate on all this?
So co-location is essentially a service provided by the exchange that
Right.
allows HFT firms to rent server space close to the exchange ports.
Correct.
Now these are costly. The hardware is costly, the rent is costly, but it makes sense for HFT firms because we want to be the fastest in the market. There is a huge advantage you get just by being fastest in the market. There's a very good movie. I don't know if you've seen it, The Hummingbird Project, a 2018 movie.
Okay.
It very beautifully explains how, like in America, HFT firms, in order to get that extra edge, how they sort of invented microwave tower trading. So
Okay.
it's a good movie. You should have a look. So I'll just like to share an incident. We were trading for this one exchange that shall remain unnamed, and we had rented co-location space, and we had sort of lobbied to get a rack space closest to the exchange ports. It's a big room. There are multiple servers, and obviously all the racks cannot be at the same distance to the exchange server port, right? So we had the server space that was closest to the ports, and we were trading continuously, market making going well. One fine day, we saw that our round trip times had increased, and we were no longer the fastest in the market.
Okay.
So we went back to our hardware team. We requested them to find out what's going on. So that exchange had come up with a rule that in the co-location room, wherever the servers are, each server will get the same length of fiber optic cable to connect to the server ports,
Okay.
the exchange server ports. So now what happened is that the server that was the farthest from the exchange port, they ended up with a straight fiber line till the exchange ports, and the companies which had their servers closest to the exchange ports, there, because the cable length has to be the same, their fiber optic cables were spooled in a way.
Okay.
Now, funny thing about speed of light is that the data transmission speed for a straight line fiber optic cable is minutely faster than the data transmission speed you get if the fiber optic cable is spooled. Because of this change in the exchange rules, even though we were seated closest to the exchange,
Right.
we ended up becoming the slowest. So it is these things that you have to find out time to time, optimize them. This is just incidents I wanted to share.
And when you say difference in the time, so this is in milliseconds, microseconds, or even nanoseconds can be there, right?
So the tick by tick data that is given by these exchanges, most of them is on the nanosecond scale. Most of the firms now are trying to optimize everything on a nanosecond scale.
Right.
But yeah, mostly round trip times are in the microsecond level till now.
So what we as retail investors might see a tick by tick data as a 1 second per, kind of per tick, which is changing.
Yeah,
There are
so
about thousands of
yeah. Most of the market participants will look at per second data, not tick by tick data.
correct, exactly.
Market makers, HFT firms, they look at tick by tick data. Every exchange update is a new line in the tick by tick data. So an order modify, order cancel, mass cancel, trade confirmation, everything is, and these things happen in nanoseconds. So it's possible that there might be thousands of updates that an HFT firm might see. That might just be 1 second, one tick update for a retail trader.
Right. Got it. So, Shans, in one of the answers, you mentioned that market makers generally never make, kind of big losses or losses. It's either flat or they are in the profits. So, what kind of risk management or the execution discipline you guys used to follow? And was it sometimes that in your 8 years of your career, did you see a big loss? And if yes, then how big it was?
So risk management wise, it's a very tight ship. We had a software based risk manager. We had backend server based limits were set on everything: maximum Vega position, maximum delta, maximum theta, maximum loss, maximum position strike wise. It was we we traded in a way that kept us very focused on just trying to gain the spread, just try to profit from the bid-ask spread. It was designed in a way that no trader could take outsized calendar spreads, no trader could take outsized large bets, even if the market was trending in a direction. For example, if election results are expected tomorrow and there is a majority government that people exit polls are estimating, it's very likely that calls will get bid, future will get bid, and market makers will end up short calls, short future, short everything, short Vega also, because there might be a move the next day.
Correct.
These risk limits were set in such a tight way that even if you go short, you reach your limit, you quickly had to either cross hedge, like I explained, across markets or cross expiries. And we could even end up doing, like, to reduce risk limits, to reduce our overall margin utilization. We would, like, for example, if our margin hits say 80%, we would automatically go into position reducing mode across the desk. Across traders, we could only trade wherein our positions were getting reduced. No single trade should be fired in increasing a position. So that is a way to control sort of your risk. Apart from this, we had a very strong what if analysis engine, which live duty trading, depending on our positions on the upside, downside, our theta, our Vega exposure, would continuously give us our total profit or loss at a 1% market move up, 2%, 5%, 10%, similar downside, and Vega wall-wise, IV moving 1% up, 2% up, 5% up, 1% down. So this heat map sort of, it was looked at before market close every day. So 3:30 market is closed, 3:20 we would have a review meeting. We would look at each trader's heat map, in which combination of market move plus IV move is making a large loss, and then the entire team would try to cover that loss. So for example, if one trader is short downside SBI,
okay,
and in the heat map it can clearly be seen that if SBI moves down 5% and the IV shoots up say 2%, I'm looking at a large loss. So the other traders would all buy banking stock downside put options to sort of offset that. Obviously, these are not true offsets because there might be a stock specific incidence. So it's not certain, but it's just a way to sort of reduce any system-wide loss moves. So
understood. Company-wide loss.
Move losses, yeah.
So we had mentioned about the bank Nifty being most liquid. And if we all remember that very recently, one of the large hedge funds, global hedge funds, actually was trying to, you can crudely say manipulate the market regarding the bank Nifty options only. So how was it possible that someone could, do this stuff in the most liquid option? So was it possible? And when you were working, what was the scenario? I mean, did you guys try to figure out that someone might be doing this? Did you find any change while trading Bank Nifty? Because it's your product, so I have to ask you this directly.
So Bank Nifty was one of the most liquid. I don't even know if it's the most liquid now.
Okay.
It was one of the most liquid products, wherein some traders, what they were doing is that they were buying HDFC Bank stock in the cash market and buying HDFC Bank puts in the option market and Bank Nifty puts in the option market, weekly expiry. And then close to expiry, before 3:30, around 12, 1 o'clock, they would start dumping all of their HDFC Bank stock in the cash market.
Okay.
Now, HDFC Bank stock, it was laughably illiquid as compared to Bank Nifty. However, the weightage of HDFC Bank was close to 40, 50, 44%, I think.
Correct.
So what they would do is they would make a loss on their HDFC Bank stock holdings.
Right.
But because they are dumping large volumes in an illiquid product, they would print money on their Bank Nifty puts. And then it would expire. So what Jane Street case was happening was, it was, I wouldn't say similar, but around the same. What was happening in the Jane Street saga was sort of like the tail started wagging the dog. So if, for example, Jane Street with, like, if I remember correctly, they had at one point of time more than 10,000 crores in margin.
Okay.
They would come in, they would buy, say, for example, a call option in heavy volumes. That call option buying in heavy volumes would force market participants who would become short that call to quickly go elsewhere and start buying futures or start buying cash market or start buying banking stocks. I mean, that buying would print their options. So normally a derivative derives its value from something. Options, we call options derivatives.
Yeah.
So options derive their values from the underlying.
Correct.
Here it became the other way around. Aggressive option position taking caused an outsized effect on the underlying,
Okay.
forced all the other market participants to take the other side of that bet and then move the market in favor of their option positions. Now, this is not wrong. This is not illegal. This is a liquidity mismatch.
Right.
And one participant taking a very large position. What I think Jane Street did wrong, where they went wrong, was that they were already making money through these trades. They started printing the close. So, for example, if you have a large long position in the underlying, very close to the settlement value, you will start hitting the market. That will force the market to close in favor of your price. These things are illegal. These things, SEBI caught them on this. Even the report that was released was top notch. I am sure SEBI has like a team of HFT traders also helping them in figuring this out. But the Jane Street saga, I think it was a case of a strategy, a black box strategy that was very profitable. It just scaled to such a large size in terms of positions that it started affecting the broader market.
So while you were doing it, could you figure out that there is some, larger play which was happening like this without maybe knowing the name who is doing it?
There is like, we can always have a hint. So it was fairly common if there are like company quarterly earnings being announced after market. There would be some very large market player who would come in and take outsized positions in the option chain, so much so that market makers will become either very long or very, very short, and then the market will move against them. So there are, obviously, it's unavoidable. That's the regulators will try to control it, limit it, but it will happen. It happens everywhere in all markets across the world.
Perfect. So, Shreyans, with that, we come towards the last part of this. How about someone watching this thinking to make a career into, kind of a market making or an HFT kind of a test? So, what are the prerequisites or what kind of a preparation a student or a candidate should do to get into this?
Most of the top HFTs will only hire from IITs. Even we were very selective about which colleges we went into, because it's a very lucrative job. It's like, even you might have seen in the news, most of the time during the IIT's placement seasons, the day zero companies are either the Silicon Valley tech giants or the HFT giants.
HFTs, yes.
So if for someone who is not an IITian or even an IITian, I would suggest reading up Options Pricing and Volatility by Sheldon Natenberg. This book was like our Bible, our Quran, our Bhagavad Gita. All of us as traders, we had like printed copies of it. We would go back to it whenever we wanted to refer something. Even when we took interviews to hire traders, one day before the interview, we would give them these books, this book only, and then ask them to read a part of it and then quiz them on it. So that book very simply explains what is option pricing, why a base valuation better than the market bid-ask mid. You can use that to bias your option pricing and then hence get edge.
All right. So for the IITians listening this, obviously this book makes sense, but a pretty disappointment for the non-IITians because these companies won't hire from them, or there is a lateral way to get into generally those.
It's very difficult. It's not easy. It's a small community.
Of course.
Like total HFT traders in India, I don't think would run into
even hundreds.
They would be in the hundreds, but
Okay.
maybe not in the thousands.
Not
I don't think.
uh,
So it's a close knit community. Getting into it requires a certain amount of skill. Uh, you must be very good with number math, mental math, like logic
quick
questions.
calculations, quick.
And like on top of all of this, what I think is the most important for being a successful trader is you need to have a calm mindset.
Of course, $1 million trades in a second. Of course.
Yeah, don't fight the trend, don't fight the market. Always be even the best traders get humbled by the market.
Yeah.
So just keep that in mind, and yeah, maybe one day you will start trading in the big leagues.
And that's a wrap with Shreyans Jain, pulling back the curtain on the world of market making. Every time you, as a retail investor, hit buy or sell, it's not a magic. It's an institution and experts like Shreyans and his firm that are ensuring that your order gets executed. We dove deep into how they view the world, how they view the markets, manage massive positions, and build their own strategies. The biggest takeaway isn't a secret formula, it's a profound understanding of the market ecosystem itself, the incredible infrastructure that powers your every move. Thanks for tuning in. See you in the next episode.